Hey, good morning traders and investors, and welcome back to our Wednesday live stream show. Bennett Tyndall, tradinganalysis.com. Thank you all for taking time out of your busy Wednesday mornings to join us. We do appreciate it. I am mostly recovered from the flu that I experienced the past couple of weeks. 95, almost back to 100%. So doing well. Glad to have you guys on board with us. Happy April 6th. We are into a new month. We are past the first quarter. There's been a lot of market volatility in 2022 so far. We've been a bit more optimistic than others and have suggested the recent pullback in the indexes to be just that, a corrective pullback, setting us up for new highs. We view the next 2 weeks, however, as probably the most important for Q2, and it will kind of establish either upside continuation or it's going to fall victim to the alternate wave count that we have been tracking. So before we get into the charts, we've got a good update plan for you this morning. Let's go ahead and bring in the team. Good morning, Terry. Good morning, Alex. How are you guys doing today?
Morning, Bennett. So glad you're feeling much better.
Thanks, man. I appreciate it, Terry. It was never any fun. I've been pretty fortunate here in Texas and haven't had too many bugs, so glad to be over it. Morning, Alex.
Hey, good morning.
How are you this morning? Doing well?
Oh, yeah, pretty well. It's a sunny, nice weather, and so spring is starting. Energy is a little bit higher everywhere, so
yeah, absolutely.
Yeah.
It's a good time of year. It's a really good time of year. It's setting us up for what could be an interesting summer. We've got a potential move on the horizon in the markets, potential move on the horizon in the crypto markets with Bitcoin. Of course, you can check out Crypto Lab tomorrow morning, same channel, 9 a.m. with Alex. So what do you guys think? Anything pressing? I know this afternoon, for those of you who are interested, we have the Fed meeting minutes. So from the March meeting, obviously we had the announcement, the rate decision, the press conference last month, and now we're getting the minutes from the meeting. Anything in there, Alex, that you're looking for specifically? Are you thinking the Fed's gonna push to the half point in April, or what's your opinion? Or I should say May?
Yeah, 4th of May, as I see on the CME tool, yeah, definitely market is pricing now over 76.6% that Fed is going to move by 50 basis points. And we had a lot of discussion, and Todd brought that up a couple of weeks back. Fed is really far, if you look the yield curve, to catch up with the inflationary pressures. So I think this move with the 50 basis points will be one of the attempts to get closer. And there is a lot of speculation, actually, that as inflation is going higher and higher, and we are going to see even more higher number in the next readings due to this latest oil and gas shocks, I think they will start to be even more hawkish. I have a 3 months Euribor forward rate to show you, and they priced in also a starting of a hiking cycle from the part of the ECB. So I hear more and more that recession is the only way out of this type of an inflation. So that actually suggests that Fed or ECB will be actually pursuing rates even higher in the months to come.
Very good, very good. And Alex will be in to bring you his macro update here in just a bit. We've seen some interesting moves. If you follow our public work here on the YouTube channel, Terry and myself put out some analysis within precious metals, specifically gold. We're going to be looking at either a confirmed breakout there. So a lot of developments that are happening this year. I do see a question for small caps. We'll be sure to hit that. All right, so Terry, Alex, I'm going to take them through the indexes. Is there anything specific, Terry, you would like me to look at for sector rotation in terms of Elliott Wave counts?
No, you just do what you got. Market momentum is mostly my topic today. So go ahead.
Sounds good. All right, I appreciate it. We'll catch you guys in just a few minutes. We're going to take you through the indexes in the Motive Wave platform. Catch you on the other side. All right, good morning. Once again, we do appreciate you guys joining us. Let's jump into it. Hard right edge of the Motive Wave platform. So I first got to just take a step back and acknowledge the daily chart in the S&P 500. Looking to the daily chart in the S&P 500, from an Elliott Wave perspective, coming out of the COVID lows, there was a lot of overlap within the corrections. And this is a topic we've talked about before. It was a bit subjective coming off of the low, and therefore, as a result, there were multiple valid interpretations. We took kind of a more simplistic approach in that the minute we saw the highest percent retracement, so the largest correction post-COVID low, we assign that our higher degree trend. And give me just 1 second. Not 100%, but I'm getting there. Had to clear my throat. I apologize. So when we saw that correction back in 2020, my goodness, September of 2020 in through October, we identified that as our wave 2 pullback. And what that means for us as Elliotticians, and we've talked about this before, this establishes 2 actionary waves and 1 correction, which would tell us, and this is the reason we have been more optimistic throughout this correction, this would tell us that we just completed the wave 4, finally pairing up to this wave 2. And with this being the case, this now sets us up for continuation to new highs in the indexes. There's a lot of bearish sentiment, a lot of uncertainties as we were seeing this move unfold. And it's really times such as this that you really need to focus on the hard right edge of the chart and see what that is reflecting in terms of the underlying sentiment of the markets. So we have been operating under the count that suggests February 24th marks the end of the wave 4 correction. and we are now seeing the final 5-wave rally. Don't get me wrong, I do expect this 5-wave completion to yield a larger market correction. Yeah, I just got a message about audio. I think we should be good though. Terry, let me know if there's any issues. So with this, this rally, we have been kind of looking to confirm this move, because with the uncertainties comes the possibility that our preferred view is wrong. And we've tracked an alternate view to kind of explain price action in the event plan A does not go our way. But for now, plan A has been going well. So what we're going to do now is we're going to get off of the daily chart and we're going to focus in on orange 3 and orange wave 4. And as we drop down in the time frame scale, you can now see the 1-hour chart. And looking at this move, while there was potentially evidence of an impulsive trend, it ultimately proved to simply be a 3-wave correction, which supports our idea that this was a garden variety pullback, setting us up for a move to new highs. In the S&P specifically, if we look at a percent retracement peak to trough of that move, we saw better than a 61% retracement and not quite a 78.6% retracement. When we met last week, we were anticipating a wave 3 high near the 1618 wave 3 and wave 1 relationship. That was at 46.19. That's where we expected last week the possibility of a pullback in wave 4. Additionally, as we were approaching that upside fib target, we had some standard divergence, momentum divergence going into the new price highs, which would support the idea we were gearing up for a correction. So the correction is upon us, and we're now tracking this as a likely wave 4 position. The wave 3 high of 46.37 did just exceed the 1618 3-in-1 relationship. This gives us downside support in the S&P between 43.97 and 44.49. Now, I want you to take note of the fact that wave count invalidation exists at 44.1678. What that means is in the event this wave 4 were to violate that level and move south of that level, that would call for invalidation of the impulsive trend. However, we do have a way to explain a deeper retracement. We're going to hold off on this because our preferred view is a wave 4. If you're interested in more on the alternate, please check us out, tradinganalysis.com. But for now, the preferred view, we're leaning towards this being a wave 4. So this is the S&P 500. And in this wave 4 pullback, this is where we can dismiss or work to dismiss the alternate possibility. The alternate possibility can be seen over here on our yellow count for those of you who are repository members. And this count would suggest, again, let's back out to the daily. This is going to kind of bring us full circle to my opening discussion. The opening discussion I had in regards to this being the largest percent correction post-COVID low, that means we have an actionary wave or a trend wave, we have a corrective wave, and then a secondary actionary wave. So 3 waves does not complete a higher degree mode of impulsive trend. What it can complete, which would allow for a deeper retracement of the post-COVID low rally, is a higher degree ending diagonal. Unlike mode of impulsive, mode of diagonals can allow for 3-wave subdivisions in the 1, 3, and 5 positions. And this would say, okay, look, maybe we're wrong. Maybe this isn't a wave 4. Let's consider worst case scenario. And the worst case scenario would suggest that that is a 3-wave move, which is the way we're tracking it. But instead of it giving way to now a wave 4 and moving higher in 5, this would say we're now in a wave 2 pullback. If we're in a wave 2 pullback, zooming in here on the daily, off of the early 2022 highs, we do have a trend that can be counted as a 5-wave move. You might be looking at this and thinking, there's no isolation, you've got overlap there, that's not an impulsive trend. But I'll remind you that on a closing basis, there is absolutely no overlap between those corrections. So it's technically valid to be considered as a trend wave. So if we consider this a trend wave into the 24th of February, that means this entire near 78% retracement of the decline has been corrective. And if this is truly corrective, then we're going to see this unwind to the downside in 5 waves, counter trend correct in 3, and then we'll see a move that takes you south of the February 24th low in the index. even if this proves to be the case, and right now we're assigning this about a 20 to 25% probability, in a perfect world, short of the uncertainties that we've had this year, I would only assign this about a 10 to 15% probability, because it's just not supported. When you dive into what makes up the S&P and do sector level analysis, there aren't many heavyweights within the S&P that would support this view. There is one very key sector which accounts for 12.5% of the index, and that's consumer discretionary. And before moving into the Nasdaq, let's take a look at the XLY. So just to kind of reiterate this view here in the S&P, we're going to use this first week or two of April to confirm a corrective trend, as opposed to, as our alternate suggests, an impulsive trend, and that will help to kind of dismiss this possibility and increase conviction from 75% on the bullish side to 85 or 90%. So let's look at consumer discretionary before we move into the Nasdaq, and I'm going to put out a video on this tomorrow. But if we take a look at the XLY, this is one sector within the S&P that is quite clear, valid to be whatever you want to call it. It's a 5-wave trend. There's a way we can call this corrective, and the reason why I am not jumping to conclusions as a result of this 5-wave decline is due to the fact that, number one, we can push it to be a correction, but number two, we look across the board, we're just not seeing support for this being a clear shift in underlying sentiment. So in the XLY, if this was 5 waves into the 24th, and this is really 3 waves back, we're going to start to see the XLY unwind significantly to the downside. Whereas, alternatively, if this is some sort of an unusual A, B, 5 of C, then we've got a new 5-wave motive trend wave, and we're going to look to dismiss the bearish count in the next couple of weeks in this corrective pullback. So a lot to happen over the next couple of weeks. It's going to be very, very key for the remainder of Q2. Now, let's go over to the SMH, and then we're going to hit the Nasdaq and wrap it up. Here in the SMH, and we'll go daily down to the 195, this is a chart that I put out on Twitter. Todd over at New Age put out a video as well on this, and our view was that this chart really best described the sentiment in the growth trade. Semiconductors being a dominant industry group within technology. I will hit small caps, I apologize, I just saw that question. This being a very dominant industry group within technology, this is just a standard 5-3-5 Elliott Wave zigzag correction. You have two key guidelines at work here, in that the C wave is a less significant angle of descent than the A wave. The C wave, you can see the time relationship, the C compared to A. A quality of time would come in March 8th. This ended into the middle of March, March 14th. So less significant angle of descent. 3 waves, and we also had divergence into the new price lows relative to the A wave low. So that's all supportive of this being a correction, setting us up for a move to new highs. In the SMH, we've successfully rallied in 5 waves to the 61.8% Fibonacci retracement of the decline, and we're now seeing a fairly sharp pullback, but this is where we're going to look to establish a corrective trend, confirm the corrective trend, and then there are some significant opportunities. If this proves to be wave 2, this will establish a runway of opportunity in semis and growth names throughout the remainder of Q2. So very excited, a lot to occur over the next couple of weeks. And then over to the Nasdaq, we'll wrap it up here and then jump back over to the team and carry into Optima, because rotations are very key in this environment. Here we have just a standard 5-3-5. We're calling the C wave a contracting ending diagonal, given the fact that we made a new price low on March 14th. We rallied in 5 waves. If we take a look at a retracement peak to trough, and we're going to go to the wave 5 high, we could go to the actual high from November. It really doesn't matter. This is a truncated 5th wave. The retracement levels will be very similar. But if we take a look at that retracement, we basically got a 618. So very similar to the S&P, between the 618 and the 786, and looking to confirm trend here in a corrective pullback. I'm going to go ahead and delete that green A and green B, because this wave 2 can unfold in a variety of ways. This can be a complex, this could be a zigzag. The more important takeaway here is that this is where markets prove that this is uptrend resumption, and that we're not going to fall victim to the alternate. So that's it for me this morning. Let's jump over to the Russell, and then we'll get back to the team. Here in the Russell 2000, like consumer discretionary, this is one sector. So the Russell 2000 small caps, or sorry, this is one index like the consumer discretionary sector that would support the idea of a 5-wave decline into its March or February area lows. But we're looking at this as kind of a disguised complex move. You have ABCW, X, ABCY. And there's a lot going for this count to suggest that this is valid. Number one, we have a 38.2% retracement of wave 3 offering support. Now, granted, we did push below that briefly here and here, but we've ultimately moved back above it. Additionally, we have alternation of corrective trend in wave 4 compared to 2. Wave 2 was a sideways flat, wave 4 was directional. Although Alex put out some interesting statistics on that recently. Another observation here is the time elapsed. So if we were to look at time elapsed between June 8th of 2020 and September 24th of 2020, and we were to project that time elapsed from the recent wave blue 5 of orange 3 high from November 8th of 21, we completed into time equality. So you have the guideline of equality, you have the guideline of alternation, you've got your 38.2% fib retracement. Nothing wrong with suggesting this to be a corrective move. Now, if this is the case, we have completed a leading contracting diagonal, and we need to see this hold wave 2 support. Wave count invalidation, meaning if we move south of 1894.45 in the Russell 2000, that's when things could get interesting to the downside, and it could be of concern. A move south of 1894 in the Russell 2000 opens up and entertains the idea that this was a 5-wave decline in the Russell 2000, thus suggesting this to be a corrective move back to the upside. This is the alternate. This is the back of the pocket count. We're going to be tracking these with clients, of course, every evening. If you're interested in staying up to date with our Elliott Wave work, we would encourage you to check it out. But that's our view currently in small caps. I do hope that helped. All right, that's it from me. I took too much time this morning. Back over to the trading analysis team. We'll get set up to take you into Optima with Terry, taking a look at some rotations. So what do you guys think? We're going to hold this correction, or do we have further lows in the indexes to come? Uh-oh, we lost Terry's audio. Terry, we lost your audio.
Sorry, I was muted.
No worries.
I think it's clear that we need to wait and see how this next week or two unfolds. We certainly have a high expectation, and I believe the market already knows that the Fed's going to raise the rates. So the market's starting to price those moves in. But, you know, we have the both of our primary trends are, well, trends, not trends, our wave counts. Both of our primary wave counts are pointing to the market to move lower over the next couple of weeks. And I think whether that becomes 3 waves or 5 waves down and we break to new lows, that is yet to show its hand. So I'm going to hold off until I know for sure. You know, I'm not loading up on new positions certainly right now. There are some opportunities out there. There's been some serious bottom fishing that's been happening, and you know, and you've seen some of these really beaten down stocks make some huge rallies. But the safer bet is to wait and see how it unfolds.
Yep, absolutely. Very well said. We're going to let that this correction play out. We're going to let it confirm the uptrend. It's going to also narrow risk assumed within any upside trades, and then we'll go from there. So looking forward to it. Exciting couple of weeks ahead. We're going to take you now into Optima. You ready to go, Terry?
Yeah. Bring it to me.
All right, let's hit it, and we'll catch you guys on the other side.
Hello, traders. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. So let's look back at last week's performance here among the 11 sectors first. And you can see that we had a very volatile group of 11 sectors here, a lot of widely varying returns, but ultimately, as far as the S&P index is concerned, we concluded the week with nearly a flat effect on the S&P. S&P netted only a 0.06% gain for the whole week. Now the NDX 100, it held on a little better, up 0.72. Both indexes rose early in the week, only to just decay the remainder of the week. Now, this came in a week that saw the real estate sector rally 4.5%. Utilities, staples, healthcare, and consumer discretionary actually all outpaced the S&P. Of course, that wasn't hard, to do, but we did have sectors also move heavily on the downside. The financial sector declined to nearly 3.3%. And as crude oil moved just below sub 100 last week, the energy sector saw another 2.15% decline. Industrials and materials were also slightly negative for the week. Now, the consumer discretionary, the technology and the communications sectors right here, they were essentially flat, and they only netted about a 0.15% gain. Well, let's fast forward to what's happening this week in the markets. And Monday started off with both indexes actually seeing a push higher. The S&P rose 0.81 Monday. The NDX rose 2%. That was a huge move. But fortunes reversed on Tuesday, with both indexes closing down in the red. The S&P fell 1.26%, and the tech-heavy Nasdaq index declined 2.11%, putting both indexes in the red starting off here early in the week. You can see for now S&P down cumulatively 0.46 and the NDX down 0.27. Let's pull this over here and I'll show you what's currently playing out here. Russell 2000 is represented here by the IWM. That got shocked, down nearly 2.9%, but I think that also includes some pre-market action in my table here. I think this symbol is live and these two are yesterday's close, and I don't know why that is, but that's the way it is. Current sector performance, the communications sector, with Elon Musk's sudden acquisition of over 9% of Twitter stock, that gave a sharp boost here to the communications sector, and this is the only sector with positive gains so far this week. As all other sectors are leaning lower, it's actually the industrial sector, which was down 1.5% yesterday. Now it's down 2% in pre-market trading here, followed closely again by technology and financials. The energy sector is getting a little bit of a bounce back up. It's still down 0.67% on the week, but you can see mostly negative as everything is pushing down. And what I was talking about with Bennett was momentum. Is it really flat? If you go all the way back here to March 25th, with the flat S&P last week and Monday and Tuesday essentially fairly neutral, our close today is about the same as what we had on March 24th. So where did those 2 weeks go? Well, they basically, it's momentum rollover here in the indexes. All right, in our relative strength sector leader scoreboard, now energy does remain in a dominant position, and that's despite it seeing momentum fade over the past 4 weeks. But the XLE has not shed any significant relative strength. That's an important thing here. Now, continued momentum declines are seen here in the staples sector, in the financial sector, and in the industrial sector. And actually, you can see that the XLF and the XLI have switched their vector colors from green to yellow. They did that last week, and they're continuing. And now we even see the financial sector has pushed itself down into the weakening quadrant. Now, this comes at a time when the real estate sector has now actually rejoined the leading quadrant. And it had a strong 3.5% gain last week, firmly outperforming the benchmark. And that period where it had just been fairly stable sitting down here was winding the spring, as I like to call it, and now I think that spring is unlaunching. So I'm looking at several strong moves here in real estate. There's some good plays there. Now we also have the healthcare and the materials sector continuing to see some improving relative strength positions and a little bit of momentum fade here. You can see that the healthcare sector had been seen with rising momentum. The last couple of weeks, that momentum is basically flat to stalled. So, but we are continuing to see increasing relative strength in the healthcare. Now, down here in the lagging quadrant, I'll animate this again for you and show you that a couple of weeks ago we pointed out the beginning indications of a hook back here in our growth sectors, both consumer discretionary and technology, with technology being slightly stronger than the consumer discretionary in terms of relative strength. And over the last couple of weeks, we've seen continued momentum rallies back up, and we actually have a northeasterly vector here in the XLY. Now, that may mostly be contributed to Tesla's performance, certainly. Now, I haven't seen these turn back into blue yet. I really like to see more blue color and further progression of the northeasterly vector, but you can't ignore the fact that we've seen growth. These two beaten down growth sectors start to gain momentum, and gaining momentum means that institutions are pumping the money back in. Now, with the exception of Twitter, if we didn't have Elon Musk manipulating the communications sector with that huge purchase there that shot, I think Twitter, I saw it up 30% or something like that after that move. But with the absence of that, the communications sector is still essentially sitting here in fairly neutral territory. All right, we've been tracking gold, so I want to continue to show you guys that. And Alex is going to come on here in a moment, and he will present his work on that. But what Bennett and I are following for now is after we completed this triangle formation, we had this rally that pushed us back up here to the $2,000 an ounce all-time high levels that goes all the way back to August 2020 highs. And, they've been in a big decline or a big consolidation ever since. And this is the first impulsive move of this significance that we've had. And that's broken out of that long triangle. But now this one needs a corrective move. And we've said be patient, continue to be patient. And you can see the corrective move down in A, and we either have a sideways, a triangulation in B, or we'll get another pop a little bit higher before we push lower. At this point over here in time, which looks to, per the calendar, late April, early May, we may start to see this roll back over. If you look over here at the gold miners, this week's performance has been mostly negative, right? So most of the momentum has faded out of these as we've been seeing gold push lower. You can see there's no longer rising momentum in many of these gold miner stocks. And actually, this is gold. This is the precious metal on the Forex exchange right here. You can see the declining momentum apparent in the precious metal. Many of these plays remain in the leading quadrant. They're just biding their time, waiting for a better trade setup. All right. Well, that's all I've got for now, Bennett. I'll send it back to you. Excuse me while I itch my nose. Can't hear you, Bennett.
Bennett, can you hear me now? Can you hear me now?
Yeah, got you. All right.
Sorry about that. Excellent work as always, Terry. Key development there in gold. We've considered the idea that the move up was actually a corrective rally. That still remains a possibility, I think, given all of the variables that it's worth tracking both. But in the event we do confirm this triangle breakout with that wave 2 correction, there's going to be some solid opportunities there. And then in regards to communications and Elon, if you're listening, we do want an edit button. Thank you very much. As long as it has an edit history, because that's where where people don't want the edit button. If you look at like Facebook, there's an edit You can edit it, but it'll show the edit history. So I think that's important with a platform like Twitter. But yeah, big move up there in the stock of Twitter as a result. I guess he's been acquiring shares since January. All right, good work, Alex. I'm gonna see if I can pass the presenter. Oh, he beat me again, but it's all right. Terry's always one step ahead. I love it. Love it. On top of things here.
Well, I go to sleep after I finish my work and I forget to switch it immediately. I get interested in listening to what you have to say. So I'm like, oh, I got to put Alex up there. Okay.
He's ready for it. All right. We've got about 7 minutes here until the open. We've got our member webinar in about 37 minutes. Alex, sir, you ready to jump in and bring us up to speed?
Yeah. Yeah, let's go.
All right, let's hit it. We'll see you guys on the other side.
Hey guys, so let's go over a little bit of a macro theme. I will sum up that the macro theme basically stays unchanged in regards of commodities higher, interest rates higher, and we are seeing some of the movements in dollar a little bit today higher. So this theme has been going for the last couple of months. And as you can see, we are going to start with a longer term chart of the 10-year yields, US. And as you can see, I mean, this is usually what we call a secular or a bigger, higher, longer term downtrend in the yields down from 1980s, as you can see. And depends how you can actually manipulate this channel, which is I would say has a secondary importance. Some people give it to a kind of a primary importance. We are trading around these levels, which are still considered to be some type of a waiting on a breakout on the upside. And I do think we're going to reach 3.1, as you can see here on this chart. So if we go to a closer chart, we had a wave count tracking for a possible reversal. We didn't get that. And as inflation goes up, and it is going to continue to go up, we need to switch this to a more bullish wave count, which will actually give us a 5-wave move up to this 3.15, which is the next resistance zone for these 5 waves up on the 10-year yields. After that, we might see a little bit of pause in a B wave. We will see how big that will be, and we can expect that maybe from September, October, then down to beginning of the first or secondary quarter in 2023, and then a further move potentially upside if we kind of have a consensus that this is a 5-wave move on the upside in the from these lows in the 10-year yields in the US. If you look to Europe, I will show you, this is the yesterday's 3 months Euribor forward curve. So here clearly you will see that market is pricing actually that rates are going to go higher in European Union. And this starts to go a little bit more down from, let's say, January, February 2023, or the end, I will say 2023. In the March, we will be trading around 1%, as you can see here. So this level, it comes around 1.35, which actually means that market is pricing that ECB will have a couple of rate increases towards the end of 2023, where afterwards, as you can see, we are starting to flatten mostly sideways. Of course, the next ECB meeting might change this a little bit, but for now, I'm just showing you what the market is pricing in for the next move in the ECB. So ECB, according to this, will actually embark on the hiking cycle pretty much most likely in June, July, or in September of this year, according to this forward curve that we are seeing on Euribor. So definitely by all of these things, we are seeing rates going even higher. We know that in May, Fed will go most likely 50 basis points to catch up with inflation. If we look also the yields in Europe, we are also facing a longer term trend line. So this is the secular trend. This is still not an impulsive move on the upside. Maybe we're going to get it, maybe we'll not. But if you can see this trend from 1980s, rates has been going down for kind of a 30 years. So we need more to actually overthrow this secular trend. And for now, we are trading around 0.674%. And definitely next resistance levels will be if we break out this channel around 2.10. As you can see here, we are trading now at the first resistance around 0.74. So a little bit more, kind of maybe expecting a small pullback, but according to this forward rates, we most likely are going to see the real yields move a little bit higher in Europe in the next year or two. Of course, next ECB meeting will be a little bit clearer in their stance. They said they're gonna definitely, they're recognizing inflationary pressures. Of course, that is very visible. Food and energy prices are going to go higher 20 to 40% in EU. So that will be in the April, June, July figures. So we are going to have higher inflation, which will make a pressure of ECB to start the hiking cycle. And then you can see a little bit of movements in euro dollar. So dollar index, let me just find this chart for you. I have a couple of them here. So dollar index is still trading in this consolidation. We are now trading a little bit higher at 99.39. With this type of consolidation, we still have a twofold view. I'm still cannot make my mind. I need a little bit more information to actually either stay with this triangle or go a little bit lower in dollar in this ABC. I cannot still digest that from the macro perspective. That depends if the Fed moves 50 basis points and ECB kind of pauses, or just from the pure interest rate differential and also a current geopolitical situation. Logically is that we are going to stay a little bit more bullish on dollar in the months to come, and then potentially we might see some reversal or a correction and euro higher if you see this slowly catch up of ECB with the Fed at least for a year and a half. So I think from the FX trade, definitely we might see euro a little bit lower in this respect, and then you might expect some reversal or correction on the euro dollar from the perspective of the interest rate differential. If you look at other commodities, you will see that oil is still consolidating. We don't get much from this last high, so 138 on Brent. We moved down at 96, then we moved up at 122. We are trading at 106 now. This looks like a small consolidation. We are not going either up or down from this range. Maybe this is a triangle or a complex. So for now, we have to treat this as a consolidation with the potential going even higher. So not much to say in regards of oil. We didn't break out, so I don't have much of a material to pick a side for you. I consider this still to be a consolidation with the probability of moving further on the upside in the oil. In the current situation, we don't see any resolution in the oil market yet. We are getting more of the sanctions on Russia. As you know, Russia is now demanding that oil and gas should be paid in rubles instead of dollars and euros. They make, I think, some amends in regards of euros, but the general Gazprom, which is a main distributor and producer of these commodities in Russia, will on the end get rubles, which will actually make a little bit more equilibrium since the ruble has devaluated greatly when the war started. So not much of a news on the oil front. If we look other commodities, I will show you also some clarity on the soybean chart. This is relatively easy Elliott Wave pattern for now, as we hold this 38.2%. So from the lows, we count very clearly 1, 2, up in 3, and this is some type of a fourth wave consolidation with the possibility of soybean going higher for the fifth wave. So commodities still looking to go on the upside. If you look Thomson Reuters CRB index, we are still in some type of a fifth wave before we get a little bit a correction and then a continuation. So definitely this paints a picture in the next at least year and a half of commodities with a small correction going higher. As we can see here, a very impulsive development from these lows in the beginning of COVID 2020. So we had a supply side shock when the commodities went up, and now we have all of the sanctions towards the one of the biggest commodity producers in the world, which will definitely, after some easing, put another pressure on commodity prices on the upside. So if you look the general picture, you can still expect the rates to go higher. You can still expect commodities to go higher. And we will see how that will reflect on stocks. Yield curve inversion happened between the 2s and 10s, I think. I didn't check out in the last couple of days, but definitely the whole yield curve still didn't invert because the shorter duration still has a much to go in regards of Fed catching up to invert the whole yield curve. So we will see how the institutional traders and funds will actually evaluate, do we have a little bit more kind of a 6 months to year leeway until this completely yield curve inversion actually happens and announce recession or not. That's a big question, and Todd has talked a lot about this, and I think it makes sense. When you observe things like that, everybody's pushing the narrative that yield curve is inverted, but actually when you look the whole yield curve, it didn't. We have just sporadic a couple of relations of the different duration which actually inverts and then goes back. So this is still unstable to have such a statement. So I think we have a couple of more months until the situation is a little bit more clearer. So that's up from me. If you want to see cryptos, Bitcoin, please join me tomorrow for the Crypto Lab with Alex. For the next week, I will potentially prepare some currencies for this live show on trading analysis, and I think it will be nice to see what is going on the currency front. So until the next week, see you guys. So that's all from me, Bennett.
Thank you so much, Alex. Appreciate your work as always, sir. Yeah, good developments there in crude. Taking us back to the 10-year yield, looking at a trend line. One of our viewers, who's actually one of our clients, came in and mentioned, if you take a look at in log scale here from October of 81, if we draw a trend line from there, through the highs of 84, we've got a big move up, kind of similar to what we saw in Q4 of 2018. Good chart on that.
I will say, interrupt you here for a second,
Please.
Bennett, and tell you that we can't see your scales.
Oh yeah.
The axis are kind of chopped off there, so just for perspective, yeah.
I mean, in that perspective, as I said, I don't think this type of trend line is so so crucial, So definitely, it looks like a 5 waves up. I will not pay much attention on that trend line. I will, as people ask me, do I give some significance to this? I give more significance to a 5 wave move than of these trend lines. Really, I mean, for me, they're secondary information.
Yeah, and it looks like you know, talk about Elliott being subjective. So can trend lines be.
Yeah,
You know,
yeah.
we could go out to the highs. Yep, exactly. And that was
So
what Mike was just commenting. And in fact, to your point here, sourcing it from there through the highs of 2007, that's pretty much where the Q4 of 18 run met resistance.
yeah.
Yep. So you're liking the idea that this is 5 waves up. So we've got to look at those fib levels and see where that could take us. But excellent work as always.
Yeah, definitely starts to look like a 5-way move, and we also see that that market is pricing Fed to go up to 2.5% or 3% to 2020, 23, 24. I don't know if the situation will stay like that, but for now, we have to be very careful, and there is no sense with still market and official figures will actually see the bigger inflation rates and figures to be bearish on rates. I mean, for now, it doesn't make sense to me.
Yep, very good, very good. Much appreciated. Great work, team. Good session this morning. If you guys are interested in more of what we do, I put out nightly strategy updates Sunday night through Thursday night, anywhere from 15 to 30, 35 minutes. It's sometimes a mini webinar, but we do include timestamps if you can, if you're interested, and you can jump right to the content that you're looking for. So, hey, check us out, tradinganalysis.com. If you enjoyed the show, please give it a thumbs up, subscribe with notifications to stay up to date. You will be seeing more public content from myself here on the channel. And of course, tomorrow morning, 9 a.m., Crypto Lab with Alex. Terry, Alex, appreciate it. Members, we'll see you in about 20 minutes. And catch you guys same time, same place next week. Have a good one. Take care.
Bye for now.
Bye.
Yeah.